Hello, everyone, and welcome back to the world's best investing podcast. Today, I bring you an update on a company that I think is increasingly positioned to become a commercial finance and banking infrastructure giant. This is a company that I first came across when I had to make an international payment. I did it with my bank. The money didn't arrive for weeks, then it got lost. I was very frustrated, and then I came across Wise. I signed up, I made the payment, and it was just so easy and so frictionless and so cheap. So this company is perfectly applying the Costco algorithm to international payments. Point is, everyone has to make international payments. So if you delight customers on that front, eventually you can use that goodwill as a platform to launch additional services. And that's what's happening now, as we'll see in this video. Additionally, to get that right, and apply the Costco algorithm, so decrease prices for end customers as they get bigger and more efficient, so quicker, more convenient and stuff. You need an amazing infrastructure, and guess what? So does every single other finance player in the world. So this is an infrastructure that banks are increasingly using, and just other financial institutions. And I'm going to share the exact data with you now. Now, if you look at the graph on the screen now, you will see that Wise's free cash flow per share, which is the orange line, is trending up beautifully. All right, so if you look at the graph on the screen now, you'll see that Wise's free cash flow per share is trending up beautifully. So this is the kind of thing we see in companies like Hims, Duolingo, Palantir, these sort of extraordinary organizations that are capable of solving a growing volume of acute customer pains in a way that's increasingly harder to replicate while producing cash that then they can reinvest into spinning the flywheel further. That's what actually drives your top line and does so defensively so that much of it falls to the bottom line. That's how free cash flow per share increases. Simultaneously, you have gross margins, which is the blue line, increasing as well. So you may recall from my last Tesla update that in successful instances of the Costco algorithm, the most typical thing to see is margins trending down with prices and then cash production trending in the absolute sense. That's usually a good thing because margins make it harder for competitors to replicate the operation. So you may recall this quote from Jeff Bezos, which I keep including in analysis in which the Costco algorithm is relevant. He said, percentage margins are not one of the things we are seeking to optimize. It's the absolute dollar free cash flow per share that you want to maximize. And if you can do that by lowering margins, we would do that. So if you could take the free cash flow, that's something investors can spend. Investors can't spend percentage margins. So he's saying, if I can print more cash with lower margins, I'm going to do it because ultimately more cash per share, more free cash flow per share is what makes the company more valuable, and lower margins is what makes it more defensible. Very simple concept. No one really understood it with Tesla in this quarter. However, here what you have is both free cash flow per share and margins going up. So this is a very rare occurrence. Companies are often forced to sacrifice one at the expense of the other, right? So then if you have both free cash flow per share and margins going up simultaneously, I think that makes the company even harder to disrupt because these guys just have better margins as they squeeze everyone out. It's just a thing you don't see much. And to me, this is quite a special instance of the Costco algorithm. So whichever way you look at it, all the metrics of total volume and the number of customers and everything is just all going up and to the right. You can go and look at those numbers yourself. They're really not that special to look at. A quick Google search will suffice. And the point is, I think these guys are getting more efficient and bigger. And as they do that, they're passing back the gains to the customers, and customers are really liking that. Now, the second part of the thesis is that as we saw with Uber, Amazon, Spotify, and many other platforms of the sort, one of the primary playbooks of our time to generate inordinate shareholder value is dominating a vertical, which is actually low-key very important, to then deploy additional verticals at a marginal cost, to therefore increase ARPU, average revenue per user non-linearly, and ultimately increase operating leverage non-linearly. That's why we've seen Spotify's free cash flow per share rise so quickly, right? So here are the two data points that stand out from Wise's Q2 fiscal year 2026 earnings report. One, commercial customer holdings are up 34% year over year, which is exceeding the growth of cross-border volume, which came in at 24% year over year. So this means that actually the cash balance on the app is growing faster now than the traditional vertical. That is important because as customers hold cash in the app, that is the gateway for additional financial services like the credit card, which is doing well and stuff like that. Interest, people get interests on their cash balances and so forth. Secondly, the other data point that stood out is that the Wise platform now accounts for 5% of revenue, up from 4% year over year. So the Wise platform is financial institutions using Wise's infrastructure as rails, so to move money around and stuff. Very bullish because these two things mean that incrementally, Wise is not just a payments app, it's actually infrastructure. On the one end, for commercial finance, which customers are increasingly leaning into, and on the other end, for just to power other financial institutions, as evidenced by the traction of Wise platform. So you see how actually the dynamic that we see today doesn't make a lot of sense. Total revenues are growing really fast. And I'll show you more data now that sort of gives you an idea of how the company is evolving. But simultaneously, the blue line, which is the EV to sales ratio, so essentially price to sales, is trading just over 4.5. So it doesn't really make a lot of sense to have a company that's growing so quickly, both the top line and the bottom line, and is doing so while sharing economies of scale with the progress actually showing in the numbers and ultimately be trading at 4.5 times sales. It doesn't make a lot of sense. This stock does trade in the London stock market, which is a fairly good reason for the valuation multiple to be somewhat depressed. But still, this seems to me like a bit of a hidden gem. So the more you look at the data, the more striking it gets. Here, the purple line is total volume. So all the payments, they move back and forth. And the volume is roughly up sixfold since 2019. And this is really what matters, right? If you look at the take rate, it's down 15% year over year, and they just continuously decrease the take rate, which is the price they charge you to send money around. As that happens, they move more money around, but it's not coming at the expense of financial performance. Financial performance is actually going up. And let me just, if you decide to look at the financials in a slightly more orthodox way, look at these two data points. You have the orange bar chart, which is cash from operations, and then the blue line, which is net income. Both are trending up quite beautifully. So whichever way you look at it, the financials are really perfect. The fundamentals are great. The philosophy of the capital allocation framework is wonderful, and we know it's one of the primary blueprints behind much of today's largest successes. And meanwhile, the stock is trading down at a very reasonable multiple. I won't say 100x potential or any of that, but if you think about it, long term, how much money can this system be moving around, both just on international payments, then on the commercial finance side of things, and then becoming infrastructure for financial institutions? What kind of business can this be? Yes, it can be 10, 20, 50, 100 times bigger down the line. And so far, the execution is simply perfect. So it reminds me a little bit of the Duolingo thesis in that the fundamentals are great, but some kind of narrative is keeping this depressed. I don't really see any narrative surrounding this company. In fact, it's not a company that many people are talking about. The only thing I can think of right now is the fact that it's one European, which is it is maybe a bit of a reason. Two, it's trading in a European stock exchange, which probably has less liquidity, is less efficient, and so forth. So this is a company that I remain very interested in long term because we know how perfect applications of the Costco algorithm evolve over the long term, regardless of the area of application. So in any business, what customers want is maximal outcomes, so optimal outcomes for essentially $0. So the closer you get to that equation by delivering more value per dollar spent and then reinvesting whatever you make into continue propelling that flywheel, the better the business does financially. And then that also squeezes out competitors. So if well managed, it turns to translate into increased shareholder value. And I mean, I keep saying this, if you look at free cash flow per share, it's doing very well. The metrics are great. So anyways, I'm going to continue studying this business for the long term. I'm not a shareholder yet, but I don't really see a reason why I shouldn't become one at some point. I have other convictions, as you know, and it's also philosophically, I am discovering more and more sort of singularity scalars of sorts, successful applications of the Costco algorithm. So I'm starting to think, why instead of owning 5 positions, don't I own 10? There's a bunch of them I could add. I think I said this about Wise 6 months ago. I could perfectly add Wise today and sleep like a baby. And it's true for a number of other companies. So philosophically, I continue reflecting on that, but for now, I'm not going to make a change and I'm happy with my portfolio. So thank you very much for joining me today, guys. If you enjoyed this video, could you please share this with one friend whom you think will enjoy it? These updates and deep dives are for free. And so the only way this grows is with your help. So thank you very much in advance. Take care. And until next time.